Welcome to the Deep Dive. This is where we take a stack of sources, really get into them, and pull out the key insights you need. Quick, thorough, no fluff.
Exactly. We help you navigate the complex stuff, understand what really matters, maybe find some surprises too.
And today, we're tackling something huge in finance. Harry Markowitz's paper, Portfolio Selection, from 1952.
A real landmark. We've also got a bit from a later chapter he did in 2008 to add some context.
Yeah, and this wasn't just about, picking winners. It was about how you combine investments, how you build a portfolio.
Right. It specifically looks at the second part of investing. You've already formed your opinions, your best guesses about future performance.
Okay.
Now, how do you use those beliefs to actually pick the mix?
Got it. So the paper splits it. First, forming beliefs, observation, experience, all that.
Right.
Second, using those beliefs to choose the portfolio. And we're focusing on stage 2 today.
That's the plan.
Okay, so let's start with the obvious thought. If you know what you expect things to return, why not just put all your money on the best one?
Yeah, the paper calls this the maximize discounted expected return rule. Seems logical, right?
Totally. Aim for the highest number.
But, and this is crucial, the paper immediately rejects that rule. Says it's flawed.
Whoa, okay. Why? Isn't maximizing return the goal?
It seems like it should be, but here's the insight. A rule that only focuses on maximizing expected return never tells you to diversify.
Never.
Never prefers it anyway. It always points to putting 100% in the single security with the highest expected return.
Even if it's super risky.
Even then, unless, two stocks happen to have the exact same top expected return.
Oh, okay.
In that specific case, any mix of those two is just as good as 100% in one of them. But critically, it's not better.
But people do diversify. Feels like common sense.
Exactly. And that's the paper's argument. Any rule that doesn't explain or recommend diversification must be wrong, as a description of behavior or as advice.
Okay, that makes sense. The math works out that way for a simple weighted average. You just max out the highest value.
Right. You put the weight Xi one on the best one.
But what about that other idea mentioned? Like putting money in all the top performers, hoping the law of large numbers helps.
Yeah, that gets shot down too. Markowitz points out the law of large numbers doesn't really bail you out with stocks.
Why not?
Because security returns are, in his words, too intercorrelated. They tend to move together too much. You can't just add more and more stocks that all dip at the same time and expect the risk to magically vanish.
Okay, so the big takeaway here is the portfolio with the highest expected return isn't necessarily the least risky one.
Not at all. There's a trade-off. A fundamental tension between getting higher returns and accepting more risk, more volatility.
And that tension is what Markowitz tries to solve.
Precisely. That leads directly to his proposal. The expected returns variance of returns rule, the EV rule.
EV?
The basic idea is simple. Investors like expected return, E, that's good. They dislike variance of returns, that's bad, it's risk.
So we need to break down expected return and variance like Markowitz meant them.
Absolutely. So expected return is pretty much what it sounds like. The average outcome you anticipate for an investment, given it's uncertain, a random variable, that's the E.
And V variance.
Variance measures how spread out the possible outcomes are around that average expectation, how much it wobbles. It's a statistical measure of dispersion.
So like volatility, risk.
Yeah. Exactly. It's the mathematical stand-in for risk in this model. Standard deviation, the square root of variance, is used a lot too. Same idea.
Okay, E is the expected upside, V is the wobble, the risk. How does this apply to a portfolio, a whole group of stocks?
Well, the expected return of the portfolio is simple again. It's just the weighted average of the expected returns of everything in it.
Makes sense.
But the portfolio's variance, its overall risk, that's the tricky part. And the really important part.
Go on.
It doesn't just depend on the individual variances of each stock. It crucially depends on how they move together.
This must be the covariance thing.
Bingo. That's the heart of it. Covariance measures how two different securities' returns tend to vary in relation to each other.
So if they both tend to go up at the same time and down at the same time?
They have high positive covariance. If one zigs when the other zags, that's negative covariance. If they move totally unrelatedly.
Low covariance.
Yeah.
Near zero.
You got it. And the formula for the total portfolio variance reflects all of this.
How so?
It's a sum that includes the weight of each asset, its own variance, which is really its covariance with itself, and the covariance between every single possible pair of assets in the portfolio.
Wow. Okay, so the group's risk isn't just adding up the individual risks.
Not at all. It's fundamentally shaped by these interactions, these covariances, how the individual wobbles sync up or cancel each other out.
That seems like a powerful idea.
It is, and it means that given your beliefs about all the expected returns and all the covariances, you can create tons of different portfolios just by changing the weights, the percentages in each asset. Each possible portfolio will land somewhere on a map of expected return E versus variance V.
So with all those possibilities, how do you choose which ones are, like, the good ones, according to this EV rule?
That brings us to the efficient set, or what we now usually call the efficient frontier.
Efficient frontier, okay.
A portfolio is called efficient if you can't do better on one dimension return without doing worse on the other, risk.
Right, Nick.
Meaning, for its level of expected return, no other portfolio has less variance. And for its level of variance, no other portfolio has more expected return.
Ah, okay. It's the best trade-off you can get. Max return for that risk or min risk for that return.
Exactly. And the EV rule says rational investors should choose a portfolio from this efficient set.
How did Markowitz visualize this?
He used geometric examples like for 3 securities. You can plot the possible portfolios. The efficient ones form a boundary and edge.
Like a curve on a graph.
Sort of. When you plot all possible portfolios with variance on one axis and expected return on the other, the efficient ones trace out a curve along the upper left edge.
Upper left meaning high return, low risk side.
Precisely. It starts at the portfolio with the absolute minimum possible variance and curves up towards the one with the absolute maximum expected return. That curve is the efficient frontier.
Okay, so why did this EV idea catch on? Why is it plausible?
Well, a huge reason is that, unlike just maximizing return, the EV rule does imply that diversification is generally a good idea.
Ah, it brings back diversification.
Yes, but crucially, the paper argues it implies the right kind of diversification for the right reason.
Okay, what's the right kind?
It's not just about owning a lot of different stocks. Remember that example of 60 railway stock?
Yeah, he said that wasn't good diversification.
Right, because they're all in the same industry, likely driven by the same economic forces. Their returns probably have high positive covariance. They wobble together.
So the right kind is about finding things that don't wobble together.
Exactly. And the right reason is specifically to reduce the portfolio's overall variance. You do that by combining assets that have low or ideally even negative covariances with each other.
Like diversifying across different industries.
Perfect example. Companies in different sectors often react differently to economic news. One industry booms while another slumps. Their low covariance helps smooth out the portfolio's ride.
That's how diversification actually lowers the overall risk profile.
That's the mechanism according to the EV rule. It's all about managing those covariances.
And this lines up pretty well with how people talk, right? Yield for return, risk for variance, or volatility.
It does map quite well onto common financial language. And the paper notes this works for diversifying across funds, too, not just individual stocks, unless the funds are perfectly correlated.
Interesting. It also mentions something about investment versus speculation.
Yeah, a brief point. It suggests the EV rule, focusing on just mean and variance, fits well for investment, where you generally dislike risk. Speculation might involve liking skewness, like a preference for lottery ticket-type payoffs, which the basic EV rule doesn't capture.
So EV is more for the prudent investor archetype.
That seems to be the implication.
Okay, so how useful is this EV principle in practice? Where did Markowitz see it being applied?
He suggested 2 main uses. One is in theoretical finance, understanding market behavior. The other is, well, actual portfolio selection by real investors or managers.
But using it for actual selection sounds hard.
That's the major challenge, then and now. To use the model, you need inputs. You need estimates for the expected return of every potential investment.
Okay.
And estimates for the covariance between every single pair of those investments.
Whoa. That's potentially thousands, millions of numbers you need to forecast.
It's a huge number. Getting reasonable inputs, as the paper puts it, is the big practical hurdle.
Did the paper offer any clues on how to get those numbers?
It suggested combining statistical methods, maybe using historical data as a starting point, with the judgment of experts. Human insight to refine the probabilities.
So use the past, but temper it with current knowledge and expertise.
Essentially, yes. Which brings us right back to that first stage we talked about.
Forming the beliefs.
Exactly. The paper gives this powerful engine for the second stage, how to construct the portfolio once you have beliefs.
Right.
But it explicitly says figuring out how to form reliable beliefs about future returns and covariances. That's, and I quote loosely, another story. A whole separate, difficult problem it doesn't solve.
So let's recap. Markowitz's big contribution with portfolio selection was this EV rule.
Right. Managing that trade-off between expected return you want and variance or risk you don't want.
And the key insight was that portfolio risk isn't just about individual asset risks, but how they move together their covariance.
Precisely. Understanding covariance allows you to build diversified portfolios where the overall risk is potentially much lower than you might expect just by looking at the individual parts.
And by mapping out all the possible portfolios, you can find the efficient frontier.
Yeah, the set of portfolios offering the best possible risk-return combinations. The EV rule says you pick from that frontier.
This really shifted the focus, didn't it? From just pick the best stock to build the best combination.
Absolutely. It became about constructing the portfolio optimally, balancing risk and return for the whole collection of assets.
So why should you listening care about a finance paper from the 1950s?
Because honestly, this is the foundation of modern portfolio theory. The concept of the efficient frontier, the importance of covariance, it underpins so much of how investment is done today.
From basic index funds to complex strategies.
You bet. It gave everyone a rigorous way to think about diversification and the risk-return relationship at the portfolio level. It fundamentally changed the game.
So thinking about that big unanswered question Markowitz left hanging, how do people today actually form those crucial beliefs about future returns and covariances in our messy, uncertain world? Considering how vital this framework is, what are your thoughts on tackling that first stage challenge? What really stood out to YE from this deep dive?